Say good day everyone. Let's continue the part 2 of the chapter 11, Financial Preparation for Entrepreneurial Ventures. We have here the slide of pro forma statements. This slide explains what pro forma statements are. So, pro forma statements are financial forecasts. They show what a company's financial situations might look like in the future. So, in simple words, a pro forma income statements predicts the company's income and expenses for the future years or even months. We have here the pro forma balance sheet that predicts what the company will own or the company assets and the company liabilities at a future date. So these statements are made by starting with the current balance sheet and then adding expected changes such as the expected sales, costs, and budgets. So why they matter? It's because they help a business plan ahead to see whether they will profit, how much money they'll have, or if they can afford to grow. Next slide is the slide of the pro forma income statement. This is actually a table. So this slide is a monthly projection of the income and expenses for a company called North Central Scientific for the year 2010. So what the table shows is that it shows for every month from January to December, it lists first is the sales. Sales is actually how much money they expect to earn. Second is the cost of goods sold or COGS. It is actually the expenses tied to making the products, including the beginning inventory or what they call as what they already have. It also has the purchases, what they will buy to sell, the ending inventory. It is actually what is left at the end. And the third one is the gross profit. It is a sales minus the COGS. By the way, COGS is the cost of goods sold. It is actually how much money they can make before expenses. And the fourth one is the operating expenses such as rent, payroll, utilities, taxes, supplies, and repairs. The fifth one is the net profit. It is the final amount the company expects to earn each month after all expenses. So in short, this slide is basically a monthly projection or monthly prediction of how much the company will earn and spend and how much profit they can expect each month. It also helps them prepare for slow months and take advantage of the profitable ones. So the next slide is the pro forma balance sheet. It is still a table. And this slide shows a projected balance sheet for each month of 2010. Ganihan, the table is about the monthly projection of income and expenses for the company, and now it is the projected balance sheet. What the table includes, we have here the assets, or it is called as the things the company owns. We have here the cash, accounts receivable. Accounts receivable is the money customers will pay later. We have here the inventory, prepaid rent, equipment, liabilities and equity, accounts payable, and the capital. So this slide predicts what the company's financial position will look like at the end of each month. So how much cash they'll have, how much inventory is left, and what they still owe, and the total value of the business. Next is the capital budgeting. What is capital budgeting? Here, capital budgeting is the process a business uses to decide which long-term projects or investments are worth expending on. Example of long-term investment is or are buying new equipment, expanding a building, starting a new product line, upgrading technology, and business wants to invest only in projects that will earn more money than the cost. Next is the capital budgeting process. It is still under the capital budgeting. So first is identify cash inflows or returns and their timing. Before approving a project, the business must estimate how much net income the project will produce each year after taxes, and then add back depreciation. So why add back depreciation? By the way, depreciation is not actual cash spent. It's actually an accounting expense. But because it reduces taxable income, it affects cash flow. So we add it back for for a true cash return. We have here the formula. The expected return is equal to x times 1 minus t plus depreciation, where x is the net, symbolizing the net operating income or the profit from the project. T is for tax rate, here for 40%, and depreciation is the yearly depreciation expenses. So capital budgeting objectives. We have here first, which project should be chosen if one can be selected. This happens when projects are mutually exclusive. Example, buying machine A or machine B, but not both. So, second is how many total projects can be selected. Some companies can approve multiple projects depending on their budget. Capital budgeting helps decide which mix of projects give the best financial return. Next, let's continue the next slide. Understanding the expected return worksheet. It's still a table, and this table shows the expected cash return for two proposals. These are Proposal A and Proposal B for 5 years. So both tables follow the formula of x times 1 minus t plus depreciation. So here is the explanation of the table columns. Here, year shows which year the return belongs to. From year 1 to year 5, X is the anticipated net income or profit the project is expected to earn in that year. This can be positive or negative. We have also here the 1 minus T. This is the income after subtracting taxes. And we also have here the X times 1 minus T. This is actually the income after taxes. You multiply x by 1 minus t. For example, if x is $500 and tax rate is 40%, where x times 1 minus 0.40 is equal to 500 times 0.60 is equal to $300. So depreciation, this is the amount the asset losses in value each year added back because it's not a cash expenses. X minus 1 minus t plus depreciation. This gives the cash inflow or expected return that the project will produce for the business. This is the most important number in capital budgeting. We have also here in a proposal A that shows in a year 1 income of $500 becomes $300 after taxes. Add $200 depreciation is equal to $500 cash return. Some years have lower income, even negative income, but depreciation still adds value. The project will still produces cash even when income is negative. So the final number in the last column are the expected cash returns the company receives each year. Now let's move on to the Proposal B. Proposal B has different income levels, where year 1 starts negative, which is negative $67, but depreciation helps create a positive cash inflow of $100. So later years 3 or 5 have higher income resulting in higher returns. So just like a proposal A, we calculate the after-tax income then add depreciation. So why the table matters? This is because the table helps the company answer the questions. Example is which project gives better cash returns? Will the project produce enough money to recover the investment? Which years are profitable and which years are weak? So By that, the decision makers will compare the cash returns of proposal A versus the proposal B and choose the project with high or higher cash inflows, shorter payback period, and higher profitability. Next is the capital budgeting, still the continuation, and we have here the payback method. So the payback method calculates how long it takes to recover the money you originally invested in a project. For example, if a project costs 100,000 pesos and it earns 25,000 pesos each year, then it will take 4 years to pay back the investment. So how the decisions are made? Okay. If the investment is paid back within the allowed time, the project is accepted. If it takes too long, the project is rejected. Here's the limitation. So the payback method ignores any income earned after the payback period. Even if a project earns huge profits later, the method doesn't consider them anymore. So, why companies still use it? Because the projects with a shorter payback usually improve short-term income. If a company doesn't have much cash, then they prefer projects that return money quickly. Next is net present value or NPV method. So the NPV method is based on the idea that the money today is worth more than the money tomorrow. You can invest money today, earn interest, and make it grow. So future money is discounted. What NPV does? So what net profit value does? It is actually converts future cash flows into today's value. And the process is called discounting. Okay, the process is called discounting. It is the process of converting future cash flows into today's value. The company uses a cost of capital like 8%, 10%, etc. to calculate how much future money is worth today. And it has also a decision rule. If NPV is positive, the project adds value which is accepted. If NPV is negative, the project loses value and it is rejected. And the next is internal rate of return method. Internal rate of return or IRR is very familiar to NPV, but with some differences. IRR or internal rate of return finds the interest rate that makes the project's NPV equal to zero. In simple words, IRR is the rate of return the project will earn. And they have also the decision rule. If the IRR or the internal rate of return is higher than the company's required rate or the cost of capital, it is accepted. If lower, it is rejected. Next is the break-even analysis. Break-even analysis helps you find out how many units do we need to sell to cover all our costs. At break-even, no profit, no loss, just enough sales to pay all expenses. Thus, capital budgeting consists of the capital budgeting process, capital budgeting objectives, payback method, net present value or NPV method, and lastly is internal rate of return or IRR method. Now we'll proceed with break-even analysis. Consists of the contribution margin approach, graphic approach, and handling questionable cost. Today we'll begin with the contribution margin approach. It is uses the difference between the selling price and the variable cost per unit minus the amount per unit that is contributed to covering all other costs. Okay, so contribution margin is equal to selling price minus the variable cost. This is how much money each unit contributes toward a paying fixed cost. Example, the rent, salary, utilities, and making a profit. For example, if a selling price is 100 pesos and variable cost is 60 pesos, then the contribution margin is equals to 40 pesos per unit. So this 40 pesos helps pay fixed cost. We have also here the fixed cost assumption. where 0 is equal to SP minus VC times S minus FC minus QC. And we have also here the break-even point of, we have the equation of 0 is equal to SP minus VC times QC divide U times S over FC, where SP is for unit selling price, VC is for variable cost per unit, and S is sales in units. And lastly is FC is equal to total fixed cost. Next, we'll move forward to graphic approach, graphic total revenue and total cost. The intersection of these two lines, that is the total revenues are equal to the total cost, is a firm break-even point. So the graph total revenue and total cost on the chart is the total revenue is equal to sales price plus times units sold, or the total cost is equal to fixed costs plus variable cost. Break-even point is where the total revenue line and total cost line intersect. So at this point, the company does not make a profit and it does not incur a loss, where revenue is equal to cost. We have also here the two additional costs, the variable cost and the fixed cost. Fixed cost is the constant even if production changes, example, the rent, salaries, and the variable cost also is there's a change with production level, example, the materials per unit. So fixed cost alone is representing the horizontal line, and variable cost is the slanted upward, and total cost is the fixed plus variable. We'll move to the handling questionable cost. That is, a certain cost can behave as either fixed or variable cost at different levels of output. Meaning to say, handling questionable cost, some of costs do not behave clearly as fixed or variable. They may change depending on the number of units produced. These costs are called mixed or semi-variable costs. And we have here the formula. 0 is equal to SP minus VC times S minus FC minus QC. Or we have also 0 is equal to SP minus VC minus times QC over U times S minus FC. So where SP is selling price per unit, VC is variable cost per unit, S is units sold, FC is fixed cost, and QC is the questionable cost. This formula sets profit 0 or break even and includes questionable cost. Now we'll deal with this figure. The dynamic manufacturing fixed cost assumption. We have here the projected cost or profits. Fixed cost assumption. So this graph shows the break-even point if questionable costs are treated as fixed cost. So as you can see the graph, fixed cost line stays horizontal because fixed costs do not change with output. Variable cost line increase as units increase. And the total cost line also slopes upward because the total cost is equal to fixed cost plus variable cost. So sales line as well is also upward sloping and increases with units sold. So this is how we interpret the graph or the figure. If questionable costs are assumed fixed, then total cost is higher at the beginning even before any units are produced. So this may cause the break-even point to shift. Next is still a figure of dynamic manufacturing, but now it is a variable cost assumption. Yes, that it shows projected cost and or profits. Okay, so under variable cost assumption, so this figure or this graph shows the break-even point if questionable costs are treated as variable costs. So what changes here is that fixed cost line remains the same, but questionable costs are added to variable costs, making the variable cost line steeper. So the total cost line increases faster as units increase. We can interpret it as if questionable costs are assumed variable, the total cost increases more sharply with each unit produced. Since we are done discussing about the pro forma analysis, the capital budgeting, and break-even analysis, we will now move on to the ratio analysis. Ratio analysis has a vertical analysis and horizontal analysis. But first, let's define first what is ratio analysis. What are ratios? Ratios are numbers that compare one financial figure to another. They help us understand how a business is doing financially. So, why ratios are useful? Ratios are useful for, first is anticipating conditions and as a starting point for planning actions. It also showing relationships among financial statement accounts. Meaning to say, to predict and plan, the ratios help business anticipate future conditions. For example, if expenses are rising faster than sales, the company needs to adjust before problems occurred. This is to show relationship between financial accounts. So, ratio as well is it make easier to compare things like profit versus sales or debt versus assets. They also simplify complex financial statements. And now we'll proceed to vertical analysis. Vertical analysis is the application of ratio analysis to identify financial strength and weaknesses. In other words, vertical analysis looks at one financial statement at a time, example, income statement, and then compares each item to a base figure. For example, on an income statement, each expense might be shown as a percentage of total sales. And that purpose is it helps identify strengths and weaknesses in the company. For example, again, if rent is 40% of sales, that is too high. If profit is 5% of sales, the economy might be struggling. Okay, since we're the vertical analysis, we'll move forward to horizontal analysis. When we say horizontal analysis, it looks at financial statement and ratios over time for positive and negative trends. Meaning to say, it looks at financial statements over a period of time or even month to a year or to another year and what it does. So horizontal analysis checks how much numbers increased or decreased. Did sales go up this year or are expenses growing faster than before or is profit improving or getting worse? So the purpose of horizontal analysis is it helps find positive and negative trends. For example, if sales are rising every year, then it is a good trend. However, if debt keeps increasing, then that's a bad trend. Next, let's proceed to the table of financial ratios. Start with owners' ratios. These ratios help owners know if the business is worth their investment. We have here the return on investment or ROI. The formula is net income divide average owner's equity. What it measures? It measures how much profit the business earns compared to the owner's capital, meaning a higher ROI means the owner is getting a good return from their investment. For example, if ROI is equal to 20%, it means every 1 peso invested by the owner earns 0.20 pesos profit. Next is the return on assets or ROA. It has a formula of net income divide average total assets. What it measures? It measures how management uses the business assets like equipment, cash, buildings to create a profit. Meaning higher ROA, the company is good at turning assets into profits. Second is the manager's ratios. These ratios help evaluate how well management runs the business daily. We have also here the net profit margin. The formula of net profit margin is net income divided sales, and it measures how much profit is left from every peso of sales after all expenses. Meaning to say, high profit margin expense is equal to expenses are well controlled. The company is efficient. Example, margin of 15% for every 1 peso of sales is a 0.15 pesos, and that is becomes the profit. We have also the asset turnover. Asset turnover has a pure formula of sales divide average total assets, and it measures the how effectively assets are used to generate sales, meaning higher turnover assets are actively producing revenue. We have also the return on assets, and it has a formula of net income over sales times sales over total assets. That this breaks the ROA into profit margin times efficiency. This shows both how much profit is made and how well assets are used. We have also the average collection period. It has the formula of average accounts receivable divide annual credit sales times 365. And it measures how many days customers take to pay. Meaning to say, higher number of days customers are paying slowly but for cash flow. Next is the inventory turnover. It has a formula of cost of goods sold divide average inventory, and it measures the how many times inventory is sold and replaced in a year. Meaning to say, high turnover is stronger sales, while low turnover is too much inventory. Average age of payables. It has a formula of average accounts payable divide net purchases times 365, and it measures the how many days the company takes to pay suppliers. Meaning to say, longer days, the company delays payment could be a good or bad depending on the situation. Next, we have here the short-term creditors ratios. This shows if the business can pay debts due soon within 1 year, like from the short period. That's why it's called short term. We have here the working capital with the formula of current assets minus current liabilities, and it measures the amount of money available for everyday operations. Meaning to say, positive working capital is the business can pay upcoming bills. And we have also the current ratio with the formula of current assets, current liabilities, and it measures the ability to pay short-term debts using current assets. Meaning to say, a ratio above 1 is safe, a ratio below 1 is risky, and can cover short-term obligations. When we say quick ratio or the acid test ratio, it has a formula of cash plus marketable securities plus accounts receivable divide by current liabilities. And it measures the ability to pay short-term debts without selling inventory, meaning to say higher quick ratio is stronger liquidity. And lastly is the long-term creditors. Long-term creditors ratios, and this shows if the company can handle long-term obligations. First is the debt to equity ratio. It is a formula of total debt divide total equity, and it measures how much the company relies on debt versus owner's capital. Meaning, high ratio, the company is very dependent on the borrowed money and it's risky. Second is times interest earned, and it has a formula of net income plus interest plus taxes divide the interest expenses, and it measures the ability to pay interest from operating profits. Meaning to say, higher if it is safer, company can easily pay its interest expenses. We have also the cash flow to liabilities formula. We have the operating cash flow divide total liabilities, what it measures. So, it actually measures how much cash is available to pay all debts, meaning higher ratio, stronger cash flow, and good debt paying ability. Let's summarize. Owners are those who want to know return on their money, the ROI and ROA. Managers look at efficiency Managers, the one who look at efficiency, the profit margin, turnover collection. Short-term creditors, they want to know if the company can pay its bill soon, the current and quick ratio. And the last one is the long-term creditors. They are the one who check debts and ability to pay interest. Debt to equity, example for that is that debt to equity times interest earned. Okay, before I end, let's define first the key terms and concepts. We have here the accounts payable. When we say accounts payable, it's about the money a business owes to its suppliers. Accounts receivable, it is the money owed to a business by its customers. Administrative expenses, it is the cost of running a business like office salaries. We have also here the balance sheet. It is a financial statement showing assets, liabilities, and equity. Break-even analysis, it is used to determine the sales needed to cover all costs. The budget, it is a plan for income and expenses over a period. We have also here the capital budgeting. It is a planning for long-term investment or project. We have cash. It is a money available on hand. Cash flow budget. It is a plan showing expected cash inflows and outflows. Cash flow statements. Report showing actual cash received and spent. We have also here the contribution margin, meaning it is the sales minus variable cost that shows profit per unit. We have also here the expenses. It is the cost incurred to operate a business. Financial expense. This is the interest or cost of borrowing money. We have also here the fixed assets. It is a long-term assets like buildings or equipment. And when we say fixed cost, it also costs that stay the same regardless of production. That's why it's fixed. You have also here the horizontal analysis. It's comparing financial data over time. Income statement. It is a report showing revenues, expenses, and profits. Internal rate of return or IRR method. It is the investment evaluation measuring expected profitability. We have also here the inventory, goods held for sale. Liabilities, it is a debts or obligations a business owes. We have also here the loan payable. It is the borrowed money that must be repaid. And the last term for this slide is the long-term liabilities. It's a debts due to after more than 1 year. And the last slide is still the continuation of the key terms and concepts. We have here with the mixed cost. It is a cost with both fixed and variable components. That's why it's mixed cost because it's the cost of both the fixed and variable components. Next is net income. It's a profits. It's a profit after all expenses and taxes. We have also here the net present value or NPV method. It is a investment evaluation calculating present value of cash flows. We have also the notes payable. It is actually a written promises to pay money in the future. We have here the operating budget. It is a plan for day-to-day business operations. Operating expenses. It is also a cost related to running regular operations. Owner's equity. It is about owner's claim on business assets after liabilities. We have also here the payback method. It is a time it takes to recover an investment. Prepaid expenses, it is a payment made in advance for services or goods. We have also here the pro forma statement. It is projected or forecasting financial statement. Ratios, these are the financial relationships used to analyze performance. Retained earnings, it is profits kept in a business, not disturbed. We have also here the revenues. When we say revenues, it is the income from sales or services. We have also here the sales forecast. It is a predicted sales for a period. Short-term liabilities, or it is also known as or also called as the current liabilities. It is actually a debts due within 1 year. Simple linear regression, it is a statistical method to predict relationships between variables. You have also the taxes payable. It is taxes owed to pay to the government. Variable cost is defined as the cost that change with production level. And lastly is the vertical analysis. It is expressing financial statement items as a percentage of a base amount. Those are all about this topic, and thank you so much.